Welcome to Trading the News Part 2, presented by DailyFX Education. As a general rule, trading into news announcements is a high-risk endeavor. To help mitigate that risk, we recommend to always have a trading plan. Trading without a plan going into a news announcement can have disastrous implications. Along with a solid trading plan, strict discipline is necessary to implement a news-based strategy successfully. Additionally, we must be prepared to abandon our trade ideas swiftly if the market is not adhering to our preconceived scenarios. We've designed 7 news trading strategies, 4 basic strategies, 2 slightly more advanced strategies, and 1 scalping strategy. In order to learn how to trade the news effectively, we suggest you focus on the basic strategies first. As you become more proficient at implementing the basic strategies, you can start to integrate the slightly more advanced strategies and eventually integrate the scalping strategy, at which point you'll have one master trading plan. Keep in mind all of these strategies are most effective when used around the larger news releases such as non-farm payrolls and FOMC meetings. The first 2 basic strategies in this list were covered in Trading the News Part 1. In the news straddle, we identified a price point above the current market to go long and a price point below the market to go short. We then placed entry orders at those prices and let the market decide which way to trade. If the news event caused the market to break up, our long entry would trigger. If the news event caused the market to break down, our short entry would trigger. In this example, you can see the market moved up after the news event, triggering our long entry. In the news reversal strategy, we waited for the market to reverse after an initial price surge. After doing so, we entered as the price reached the original price level traded at before the release. In this strategy, we attempted to wait out the volatile market conditions that typically follow news releases, looking for calmer trading conditions. In this video, I'm going to introduce 2 additional simple strategies, 2 advanced strategies, and finally our scalping strategy. Let's begin with the first of the new basic strategies, the pre-release trend following strategy. In the following examples, we will look at the euro-dollar pair around various non-farm payroll releases. NFP can be the most single significant market moving event for the US dollar each month and often provides good news trading opportunities. In the case of the pre-release trend trade, we will look at the NFP release on May 8, 2009. But before pulling up some charts, let's take a look at a few important rules we'll want to follow. First, we'll want to use a daily chart and plot a 10-day simple moving average on it. Then we need to determine the direction of the trend. If the trend is up and the current candle is completely above the 10-day SMA, then we'll buy. If the trend is down and the current candle is completely below the 10-day SMA, then we'll sell. And finally, we'll make sure to enter our trade 5 minutes before the news release. In this strategy, we're going to enter the trade before the news release. As I mentioned, the challenge with trading the news is getting in and out of the market at your desired prices. The reason this can be difficult is that once the news hits the wire, there's really no way to tell which way the market will move or the amount of liquidity that will be available. If you need to exit quickly, there's no way to know if your order will be filled at the level you're requesting. One way to mitigate that risk is to enter the market before the release. The advantage to getting in before the news event is that one of your orders, your order to open in this case, will likely be filled as expected. And if you win half of your trades, you only have to deal with slippage on the exit of the losing trades. Let's assume this buy position was filled at the price I wanted. Now, after the news event comes out, the market spikes up, and I click to close my trade here. Due to market volatility and lower available liquidity around news events, this quick spike up might be extremely short-lived, meaning my trade might actually get filled down here, which is currently the best available price. Now, FXCM's no dealing desk does give you a better chance of receiving the fill you wanted compared to some other FX firms. This is because of the number of banks providing markets to FXCM traders like you. Additionally, as a no dealing desk firm, FXCM is not taking a market position when you place trades. Therefore, we too hope that you receive the fill you're looking for, as our interests are aligned with yours. Now, moving on with this strategy, the question becomes, do you buy or sell, and where do you place your protective stops? Many traders who use this strategy assume that the trend will not change. So if the trend is up, they will buy, and if the trend is down, they will sell. You can use a simple 10-day moving average to determine the direction of the trend. If price action is trading below the 10-day moving average, the trend can be considered down. If price action is trading above the 10-day moving average, the trend can be considered up. There are also several other ways to analyze and determine the trend. The idea, though, is to develop a consistent opinion of the direction of your trade based on the market rather than just guessing. On May 8, 2009, the euro-dollar is trading above the 10-day moving average, just prior to the release of non-farm payrolls. Because the trend is up, we could buy at 1.3430 a few minutes before the release and place a protective sell stop at 1.3375. A limit order to take profits can be placed twice the distance of the stop, giving us a 1-to-2 risk-reward ratio. Since the stop distance was 55 pips, we could look to take profit 110 pips above our entry, or at 1.3540. After this news release, the euro-dollar market experiences its typical volatility, then begins to move upward and does hit our take profit level for a 110 pip profit. In this case, because we're looking to pick up a pretty large gain, we didn't have to deal with potential slippage on our exit because we exited the market after volatility had subsided. Now, why choose this strategy at all? Well, the rationale behind the strategy is that the market has already started to prepare for the news release, and due to the current trend, the news release will likely push the market further in the direction it was already headed. Our next strategy is the post-release trend following strategy. Again, let's set the stage with a few basic rules that we'll want to follow. First, we'll want to use a 60-minute or 4-hour chart with this strategy. Next, we'll need to draw support and resistance lines on the chart. Then, we'll need to determine the direction of the daily trend. If the trend is up, we'll need to look for buying opportunities near the support line. If the trend is down, we'll need to look for selling opportunities near the resistance line. And finally, we'll want to enter our trade when the price reaches the trend line. We'll also want to set our limit 3 times the distance of the stop, which creates a 1-to-3 risk-reward ratio. Now, the basic premise of this strategy is to allow the news to be a catalyst for a move toward long-term support and resistance levels. Here's an example from the NFP release on January the 9th, 2009. On a daily chart, we have a series of lower highs and lower lows, so we can look for a short sell opportunity in the direction of the downtrend. Just prior to the release, we can see a resistance trend line connecting the December 29th high and the January 8th high on this 1-hour chart. In fact, the current prices are fairly close to the resistance line, so it seems likely that prices will reach this line upon the release. As we wait for the release, the resistance line is near the 1.3720 level. With prices close to this line, we may get a spike up above it. So we wait to see if prices pierce the line, then drop back below on a 5-minute chart. Sure enough, as the news is released, prices spike up to a high of 137.49, and the 5-minute candle closes back below the resistance line, which rests around the 137.20 level. At this point, we can place an entry order to go short at 137.20 with a stop 10 pips above the recent high, or 137.59 for the stop. That's a stop distance of 39 pips. And since we wish to maintain a 1-to-3 risk-reward ratio, we look for a profit target of 117 pips, or 3 times the distance of our stop. That's a price level of 136.03. On the next candle, the price does move up to the resistance line again, and our entry order is triggered at 137.20 to go short. Within 15 minutes of the trade getting triggered, the price reaches our profit target. Now, we've just gone over 2 additional basic strategies, so that completes the first 4 of our basic strategies. Now, we'll move on to discuss our 2 advanced strategies. The advanced strategies are more dynamic, so we're going to need to make some calculations after the news is released. The first advanced strategy to discuss is the dual spike breakout. Due to the reduced liquidity around news events, volatility increases tremendously, leaving spikes for a few minutes after the release. We'll use a 5-minute chart and focus on non-farm payroll. The strategy rules are simple. First, after the NFP release, we want to wait 15 minutes, or for 3 candles to close. Next, we want to note the highest price and the lowest price of the 3 closed candles. After that, we need to place an entry order to go long at the highest high of these three candles. We'll additionally need to place an entry order to go short at the lowest low of those three candles. Finally, once one order is triggered, we'll take profit at twice the distance of the high-low channel. Essentially, with this strategy, we look to place a breakout trade at the price extremes of the spikes on the news releases. So let's take a look. Here's an example of price action around non-farm payroll data, February the 6th of 2009. For this strategy, we want to watch 3 5-minute candles to close after the release. Once that occurs, we can make a note of a high of 128.42 and a low of 127.68. A long entry order is placed at 128.42 and a short entry order is placed at 127.68. We can then wait for one of the orders to trigger. In this example, about 15 to 20 minutes after the orders were placed, the price triggers the long entry order at 128.42. We also can leave the short entry order active to act as a stop on the trade. In this case, the distance between the entry and the stop is 74 pips. So we can look for a profit target of twice the distance of the stop, or 148 pips. We anticipate taking profits then around the 129.90 level. Later in the day, the profit target was reached and the trade was closed. Now, I'm actually a fan of this trading strategy, and here's why. After a news release, price action typically becomes volatile. In a short period of time, prices often seem to bounce all over the place, whipsawing up and down. This happens because of market indecision. It takes time for the market as a whole to analyze what the news release really means. Was the release bullish for the pair, bearish for the pair, or neutral? It takes time for the true or real effect to play out. So right after the release, as prices are whipsawing up and down, you'll often see some very short-term highs and lows, or relatively strong support and resistance levels setting up. So by using these points as your possible entries if the market moves back there again, often works quite well. Typically, when the short-term support and resistance levels are broken, you'll see the market continue to trend in the direction of the breakout for most of the day, just like it did in this trade. Our next strategy is the initial spike fade, and here are its rules. First, after the news release, wait for the first 5-minute candle to close. If the price is near the spike high or low, then fade the move by trading in the opposite direction. Try to enter as close to the high or low as possible. Next, place a stop 15 pips above the high for a short trade, or 15 pips below the low for a long trade. Finally, take profit at least 2 to 3 times the distance of your stop. Now, let's move on to an actual trading example. On March 6, 2009, NFP is released, which creates a spike upward. As the first 5-minute candle closes, the closing price is near the high price, so the trader decides to fade the move. This means the trader will look for prices to retrace the strong move up it just made back to the downside. The trader enters at the open of the next candle around a price of 127.34 and places a stop 15 pips above the high around 127.53. This is a stop distance of 19 pips. The trader looks for 38 pips of profit for a target of 126.96. Just a few minutes later, the profit target is reached and the trade is closed for a profit. We've now come to our final news trading strategy, the pre-release calm. As a scalping strategy, it's the most advanced strategy and requires strict adherence to its rules to be effective. However, the strategy itself is quite simple, as you can see here. Here are the rules. First, you'll want to use a 5-minute chart. Beginning 12 hours before the release, you'll want to identify levels of support and resistance on the 5-minute chart. Then very simply, you'll sell at resistance and buy at support. In the hours prior to a major release, the market often stagnates between a support and resistance level. In our opinion, this time may offer the best opportunity for a simple scalping strategy. The reason is that most market participants are waiting for the release, so trading volume is light and movement is small. While small movement is not really the ideal situation for a scalper, the existence of precise support and resistance levels is. These tight trading ranges typically set up because there are often large orders on either side of the range, keeping prices contained inside of the range. Prior to the release, there's a lot of uncertainty. Will the market make new highs, new lows, or be unaffected? Even the best traders know predicting future market direction is a real challenge, especially prior to a news event. So the trades that are taking place are usually small enough that prices remain contained inside the bounds of the larger orders piled up on the outside. Thus prices will bounce between the two extremes until the actual release. To be an effective scalper, you must possess tremendous discipline. Once the support and resistance levels are defined, you'd like to sell at resistance with a stop just above resistance, or buy near support with a stop just below support. Additionally, you must exit immediately on any penetration of the predefined range. So let's take a look at a past example. In early April of 2009, we had a setup for a pre-release COM. On April the 2nd, 2009, the ECB was scheduled to release their interest rate decision. Then 24 hours later, the NFP was scheduled to be released. Since both of these announcements had an ability to move the euro-dollar, there would be limited trading activity between these two releases. Even without a major release on the day before, oftentimes the 12-hour period prior to the release can provide a good environment for this strategy to work. Several hours before NFP was scheduled to be released, a trader noticed this trend channel forming on a 5-minute chart. About 3 hours before the release, the price approached the resistance line, offering an opportunity to take a scalping trade short. The trader opened a short trade at 134.70, where the resistance line rested. In a scalping trade, you generally look for a small number of pips, which could be as small as 10 to 20 pips. There were a couple of good scalping opportunities as the prices bounced around near the resistance line prior to the NFP release. The trader could have easily picked up 30 to 50 pips on 2 to 3 trades. In scalping trades, since you look for a small number of pips to profit on, many times your stop is going to be wider than your take profit level. However, if the market doesn't quickly push the price in your favor, that could be a sign the trade won't work out. Now, the foregoing is a sampling of strategies to use when trading the news. Remember, due to the increased volatility around news events, there are additional risks to trading news events, the primary risk being capturing your entry and exit prices as desired. Therefore, news trading is not suitable for all traders. We hope you found this video helpful, and we encourage you to attend a live webinar on trading the news with our course instructors. In the webinar, instructors will relate what you have learned here to current market and trading conditions. Instructors will also field Q&A on the topic of news trading. Thanks for watching, and we'll see you in the live webinars.